In today's video, we're diving into 3 innovative approaches to leverage the moving average indicator for precise trade signals for those dedicated to enhancing their trading skills. Make sure to watch till the end of the video now. Let's dive. What is an EMA? And firstly, what exactly is a moving average? It's a straightforward technical indicator that computes the average closing price of an asset over a specified time period. For instance, a 10-period moving average calculates the average closing price of the last 10 candles. The moving average serves as a tool to reduce market noise, offering a clear portrayal of trends. Different moving averages cater to distinct trends, with a 200-period moving average identifying long-term trends, while a 20-period one identifies short-term trends. Popular choices include 20, 50, 100, and 200 length moving averages. Now let's uncover the specific application of the moving average that can enhance our trade decisions. First, you need to understand how to identify the trend. The moving average, being a trend indicator, aids in discerning the direction of price trends. We employ 2 how to identify trend techniques for this. 1. Price versus moving average. The location of the price relative to the moving average helps determine market trends. An upward price above the moving average signals an uptrend, while a downward price below it indicates a downtrend. In sideways markets, it's prudent to wait for a clear trend. 2. Using 2 moving averages. Employing 2 moving averages with different settings offers both short-term and long-term trend analysis. This approach provides a nuanced understanding of market trends and can act as stronger support and resistance. Another important aspect is moving average slope. The moving average slope, the slope of the moving average, offers insights into the strength of the TR trend. A steep slope signifies a strong trend, while a gentler slope indicates a weaker one. Recognizing the trend strength helps refine entry strategies. Lastly, you need to understand large versus small moving averages. Combining 2 moving averages like the 50 and 200 MA helps identify trend direction. When the smaller moving average is above the larger one, it signals an uptrend, and vice versa. This method aids in spotting buying or selling opportunities. Now, I am going to teach you how to identify reversals. There are 2 techniques that come into play. 1. Price crossover. Crossovers between price and the moving average signal potential reversals. Crossing from above suggests a bearish reversal, while crossing from below indicates a bullish reversal. 2. Moving average summary. Crossover using 2 moving averages with different periods like the 50 and the 200 EMA helps identify trend reversals. A crossover where the smaller moving average crosses below the larger one suggests a bearish reversal, while the smaller moving average crosses above a larger moving average suggests a bullish reversal. Finally, the moving average is very valuable in identifying dynamic levels of support and resistance. In an uptrend, the moving average often acts as a support level, providing buying opportunities, while in a downtrend it acts as resistance, offering selling opportunities. As we conclude this insightful video, we've covered how to effectively utilize the moving average indicator for trading. For those eager to learn about more advanced trading indicators and strategies, make sure to check out the links conveniently provided in the description. If you found value in this content, be sure to hit the like button and subscribe to